Chapter 15, IAS 37 and IAS 10. The contents to be covered in this chapter are as follows. IAS 37 Provisions, Contingent Assets and Contingent Liabilities. Provisions. Recognition Criteria. Obligations. Measurement. Specific Scenarios. Contingencies. Contingent Liabilities. Accounting. Contingent Assets. Accounting. IAS 10 Events after the reporting period. Adjusting events. Non-adjusting events. Accounting. Why an accounting standard for provision? Number 1. Provisions were often recognized as a result of an intention to make expenditure rather than an obligation to do so. Number 2. Several items could be aggregated into one large provision that was reported as an exceptional item. Exceptional items are generally ignored from the regular comparisons. Number 3. When provisions aren't disclosed adequately, the significance of it becomes difficult to ascertain. Objective of IAS 37. The objective of IAS 37 is to ensure that appropriate recognition criteria and measurement bases are applied to provisions, contingent liabilities, and contingent assets, and that sufficient information is disclosed in the notes to the financial statements to enable users to understand their nature, timing, and amount. Provision. A provision is a liability of uncertain timing or amount. Liability. A liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Recognition of a provision. Number 1. An entity has a present obligation, legal or constructive, as a result of a past event. The obligation must give rise to a potential outflow of economic resources. A. Legal obligation. Obligation that arise due to enforcement of laws. B. Constructive obligation. This is where the company establish a valid expectation through a course of past practice, regardless of whether there is a legal requirement to perform the task or not. Number 2. A reliable estimate can be made of the amount of the obligation. A. If the provision relates to one event, this should be measured using the most likely outcome. B. If the provision is made up of numerous events, then the provision should be measured using expected values. Number 3. There is a probable outflow of economic resources. The outflow can be categorized on the basis of degree of probability as virtually certain, probable, possible, and remote. Only if there is a probable event, then provision must be made. If not, the treatments are different for each. A summary of the accounting treatment is: for degree of probability, virtually certain, outflow, recognize liability, inflow, recognize asset. For degree of probability, probable, outflow, recognize provision, inflow, disclose contingent asset. For degree of probability, possible, outflow, disclose contingent liability, inflow, ignore. For degree of probability, remote, outflow, ignore, inflow, ignore. Contingent liability. A possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events not wholly within the control of the entity. Or B, a present obligation that arises from past events but is not recognized because it is not probable that an outflow of resources embodying economic benefits will be required to settle the obligation, or the amount of the obligation cannot be measured with sufficient reliability. Contingent asset. A contingent asset is a possible asset that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events, not wholly within the control of the entity. Double entries. A provision is created by charging an expense and recognizing a liability. Debit, expense, for example, administration costs. Credit, provision. Subsequently, a provision may be increased. Debit, expense, for example, administration costs. Credit, provision. Or decreased. Debit, provision. Credit, expense, for example, administration costs.